Here is a number that JP Morgan Asset Management calculated and published. A $10,000 investment in the S&P 500 made in January 2005, left completely untouched until December 2024, would have grown to $71,750. That's a 10.4% annualized return over 20 years. Now here's the same $10,000, same index, same time period, but this investor missed just 10 days. The 10 best days out of 7,300 trading days. Just 10. Their portfolio grew to $32,871, not $71,750. $32,871. They lost $38,879 by being out of the market for 10 days out of 20 years. And if they missed the best 60 days, their $10,000 is now worth $4,712. Below what they started with. A net loss from a 20-year investment in the S&P 500 because of 10 mistakes or 60. And the worst part of that data? According to JP Morgan's own research, 7 of the 10 best days over that 20-year period happened within 15 days of the 10 worst days. Meaning, the investors who panicked and sold during the crash missed the recovery that immediately followed. They didn't just lose the worst days. They lost the best days because they were the same days. This is not bad luck. This is a documented, predictable, repeatable pattern of beginner investor behavior that costs Americans billions of dollars every single year. Today I'm going to walk you through the 7 most common and most expensive mistakes beginner investors make. For each one, the specific behavior, the real data behind what it costs, and the exact countermove. No filler, no vague advice, just the 7 mistakes, the math, and the fix. Let's go. Mistake number 1, and the one the JP Morgan data just demolished, trying to time the market. The logic seems sound. Buy low, sell high. Get out before the crash, get back in after. But the data makes this devastatingly clear. Timing the market requires being right twice, knowing when to sell and when to buy back in. Miss either by a few days and you lose the best days. And as we just saw, missing the best days is the difference between $71,000 and $4,700. Visual Capitalist summarized this from JP Morgan's 20-year research. Missing the best 60 days would have caused investors to lose a striking 93% in value compared to staying invested. The countermove is the simplest concept in all of investing. Time in the market beats timing the market. Not a single 20-year rolling period in S&P 500 history has produced a negative return for a fully invested, diversified investor. Not the Great Depression, not the 2008 crash, not COVID, not one. The data from JP Morgan's Guide to the Markets is unambiguous. The S&P 500 has delivered positive returns over every 20-year rolling period in its history. The fix: automate a monthly investment. The same amount every month, regardless of what the market is doing. This strategy is called dollar cost averaging. You buy more when prices are low, less when prices are high, and you never have to time anything. Mistake number 2, and the one that quietly destroys more beginner wealth than any market crash. Not starting because the market feels too high. In 2024, the S&P 500 made nearly 40 all-time highs according to JP Morgan Private Bank's research. Every time it hit a new high, someone somewhere said, "I'll wait for the pullback." And every time the pullback came, they said, "I'll wait until it feels stable again." This is the trap, because the market spends the majority of its time near all-time highs. Waiting for the right moment means waiting forever. And every month you wait is a month of compounding you never get back. Warren Buffett addressed this directly. The stock market is a device for transferring money from the impatient to the patient. And Jack Manley, global market strategist at JP Morgan Asset Management, made it even more concrete in a 2025 CNBC interview during the tariff sell-off. When there's a bad sell-off, that bad sell-off is typically followed by a strong bounce back. Given the nature of this sell-off, the likelihood for that bounce back, whenever it occurs, to be pretty concentrated and pretty powerful is that much higher. The market has always recovered. Always. In 150 years of data, the fix starts today. Not Monday, not after the next earnings report. Today. Mistake number 3, and the one that converts temporary paper losses into permanent real losses. Panic selling during a market crash. The 2008 financial crisis saw the S&P 500 decline 38% between September 2008 and March 2009. Millions of Americans sold, locking in catastrophic losses. And 7 of the 10 best days of the following 2 decades happened during that same period. The investors who panic sold didn't just experience the crash. They missed the recovery. They experienced the worst of both worlds, the loss and the miss. And as the FMP Wealth Advisors research calculated, if you had been out of the market on just those 10 best days over 20 years, your $163,000 investment would have grown to $1 million as a buy and hold investor, but to under $500,000 for the panic seller. The fix, and it's a mindset fix as much as a strategic one. Define your time horizon before you invest and commit to it. Barry Glassman, CFP and founder of Glassman Wealth Services, said in a CNBC interview, if a client in their 50s has money in retirement accounts, those are long-term dollars that over the next 10 to 15 years will likely outperform in stocks compared to other choices. The question to ask during every market crash is not should I sell, but has my time horizon changed? If the answer is no, the crash is noise. And noise has no business making your decisions. Mistake number 4, and the one that destroyed fortunes in 2021, chasing past performance. JP Morgan Private Bank identified this explicitly as one of the most popular investing mistakes of 2024. In 2021, meme stock madness minted millionaires seemingly overnight. Fear of missing out drove investors into stocks such as GameStop as they rocketed higher, and many of them took losses when the stocks crashed in the subsequent weeks. The behavior is always the same. A stock or fund has delivered extraordinary returns, so investors pile in, right as the run is ending. ABSLI's research documented this pattern precisely. Investors often see strong past performance and buy at the peak, then watch performance decline rapidly. The data behind this is unambiguous. According to Dalbar's research, cited in JP Morgan's own educational materials, the average stock fund investor consistently underperforms the S&P 500 index itself. Not because the market is doing badly, because investors buy after the run-up and sell after the decline. They chase yesterday's winners and panic sell today's losers. The countermove: never let a performance chart be the primary reason for buying anything. Buy based on fundamentals, what the business does, what it earns, what it's worth. Or better yet, buy the index. On everything. Chase nothing. The index doesn't care about last year's hot stock. Mistake number 5, and the one that feels like confidence but acts like gambling. Zero diversification. Saxo Bank's research on beginner investing mistakes captured this exactly. One of the most common beginner mistakes is putting all your money into just a few investments. Many new investors hear about a stock that is getting a lot of attention, and they put all their money into that one opportunity. This is concentration risk, and it creates portfolios that are extraordinarily fragile. One bad earnings report, one regulatory change, one CEO scandal, one sector rotation, and a concentrated portfolio doesn't just underperform. It can lose 40, 50, 60% while the broader market is up 10. Warren Buffett, who is famously concentrated in his own portfolio, has said something that most people don't quote. Diversification is protection against ignorance. It makes little sense if you know what you are doing. The implication is clear. If you don't know exactly what you're doing, and beginners don't, diversification is not optional, it's mandatory. And the most accessible form of diversification for any American investor, a total stock market index fund. Own all 3,000 plus US companies in one fund. No concentration risk, no single point failure, and historically, better performance than most actively managed concentrated portfolios over any 15-year period. Mistake number 6, and the documented root cause of almost every other mistake on this list: emotional decision-making. ABSLI's research on investing mistakes identified emotional investing as one of the most documented sources of loss. Emotions like fear, greed, and panic lead to irrational investment decisions. Investors who become fearful when the market is volatile may sell, missing potential gains when the market rebounds. Investors who become greedy may buy into a hot stock without researching fundamentals, leading to losses when the bubble bursts. Fear produces panic selling. Greed produces peak chasing. Both are documented, predictable, and costly. The professional solution to emotional investing is a written investment policy statement, a document you write before any market volatility that answers, what am I investing for? What is my time horizon? How much decline can I tolerate? And what will I do if the market drops 30%? Write the answer when you're calm, then follow it when you're not. The Mentos research on beginner investing confirmed this. To avoid emotional investing, it's important to stay disciplined and stick to a well-thought-out investment plan. Avoid making impulsive decisions based on emotions and focus on long-term goals. Your action step: write 3 sentences describing your investment plan. Time horizon, risk tolerance, action on a 30% decline. Then never deviate without rereading them first. Mistake number 7, and the most universal: waiting until you have enough money to start investing. This mistake is invisible because it feels responsible. I'll start when I have $10,000 saved. I'll start after I pay off this debt. I'll start when things settle down. But the data makes the cost of waiting brutally clear. From our JP Morgan data, $10,000 invested in 2005 and left untouched for 20 years grew to $71,750. That is the power of starting. Most people starting today won't invest $10,000. But Fidelity, Vanguard, and Schwab all offer index funds with no minimums. You can start with $1. And according to compound interest mathematics, starting with $1 at 25 is worth more than starting with $1,000 at 35. Michaela Aloka, personal finance coach and CNBC contributor, stated this plainly: even if you're only contributing $5 a month, you're doing something. And that something changes everything over time. The math on this is precise. Someone who invests $200 a month starting at 25 at 8% annual return accumulates over $700,000 by 65. The same $200 starting at 35 produces $280,000. Waiting 10 years cost them $420,000. Not because they earned less, because they started later. Your action step: open a Roth IRA today. Put in whatever you can: $25, $50, $5. The amount is irrelevant. The start is everything. 7 mistakes. Trying to time the market. The JP Morgan data shows 10 missed days cuts your portfolio in half. Not starting because the market feels high. In 150 years, it has always recovered. Panic selling during crashes. You lock in losses and miss the recovery. Chasing past performance. Dalbar shows average investors consistently underperform because of this. 0 diversification. Concentration risk is gambling, not investing. Emotional decision-making. Fear and greed produce documented, predictable, costly outcomes. And waiting to have enough to start. 10 years of delay cost the average investor over $400,000. 7 mistakes. 7 fixes. All documented. All avoidable. One final thought from JP Morgan's own research, and it is the most important thing in this entire video. In 150 years of stock market history, there have been wars, natural disasters, acts of terror, financial crises, a global pandemic, and more. Yet the market has always eventually recovered and climbed to new all-time highs. 7 mistakes, all of which involve fighting that historical reality. The fix: stop fighting. Start investing. Stay invested. If this video gave you something real, share it with one person about to make one of these 7 mistakes. Subscribe for this kind of content every week. And drop in the comments, which of these 7 mistakes have you made? Be honest. I read every single one. See you in the next one.